Okay, excellent. Now that we know what working capital is and why companies need sufficient working capital to carry out their core business operations, we will use this lesson to dig deeper and explain the trade-off businesses face when they try to optimize their working capital. There have been many businesses, some quite profitable, that have closed shop due to bad working capital management. See, the issue is that sometimes, if working capital is too thin, we can have liquidity problems and cannot repay creditors and trade counterparties. So, a firm's working capital provides sufficient cushion in terms of liquidity. Too big of a cushion would mean we've invested too much in working capital, and we are being inefficient, as this is money that could have been invested elsewhere. The money could have been used to repay financial liabilities, invest in a new CapEx project, or it could have been redistributed to shareholders. So, we have two conflicting goals: liquidity and profitability. A high investment in working capital improves liquidity and decreases profitability. The level of working capital a firm maintains isn't entirely up to its full control because it depends on negotiations with external parties, such as clients and suppliers, with current production capabilities. But finance managers must make sure the two extreme situations will be avoided. One is called overtrading and represents a firm that has insufficient working capital to maintain its current level of sales. This is when our working capital is too thin and current liabilities have grown higher than current assets. A disaster in terms of liquidity. The opposite case is called overcapitalization. It consists of maintaining an excessive level of working capital and missing other investment opportunities, given that our cash is not used and remains blocked in the business. And to make things even more delicate, we must know that when some aspects related to working capital items change, others will be affected too. So, if we offer customers a discount if they paid us earlier, we could increase our cash position, as many people who owe us money will pay us earlier and take us up on the offer. However, this will likely reduce our profit margin and will entice these customers to order other products from us, which will decrease our inventory. The overall effect will be that we'll reduce our receivables, decrease profit margins, improve our cash position, and decrease inventories. See, working capital items are interrelated, so we must consider how the change of one parameter affects the others. Okay, great. In the next several lessons, we will focus on the way we typically predict trade receivables, inventory, and trade payables. This will do for now. Thanks for watching.